Hello, everyone, and Happy New Year. Welcome to the Verdence Capital Advisors 2018 Themes and Outlook. This year, we're starting the year off with a new version of our quarterly commentary. We're going to talk about our themes going forward, and also at the end of the presentation, we're going to give you our website where we have a written version of our themes. I'm particularly excited about this commentary and this year's theme paper. Because we've hired a new head of portfolio strategy. Megan comes to us from Deutsche Bank, where she worked in research for the Americas. And so Megan and I worked on this commentary together. So before we get started, I just want to point out, this is Megan. And welcome to Verdence Capital Advisors, Megan. So let's get started. And as we can see on the first chart, it was a great year for equities across the board. U.S. stocks were up significantly as the economy continues to recover and actually start to accelerate its recovery. S&P 500 up 21%. The broader market, not quite up as much, but still up double digits. So a great year across the board in all classes in U.S. stocks. International stocks were up significantly, actually beat the U.S. this year. Developed markets up over 20%. Emerging markets up almost 40% this year, really largely driven by Asia. So a great equity year in terms of the market. From a sector standpoint, basically every sector had a great year other than energy and telecom. They both lagged for different reasons. Energy did rally at the end of the year and is rallying in 2018, but for the year as a whole, we did see most sectors higher. Credit, really just a flat year. Yields started in the mid-twos on the 10-year, went down, and then came back, ended the year almost where it started. So again, we continue to think that yields are going higher. We're going to talk about that in one of our slides. Last year, essentially investors got their yield, unless they owned high yield securities, and they got a little bit of a bonus, but not much. In terms of commodities, metals were the story. Precious metals, industrial metals all went higher, and some significantly higher, again, on anticipation of global growth and CapEx recovery spending. Energy and some of the other commodities actually had negative years. So mixed bag in the commodity market, and the dollar was down. So as we move in our 2018 themes, our first theme is the Lehman lost decade. And essentially what that refers to is back in 2008, 2009, we remember the financial calamity that was the Lehman Brothers default. When Lehman Brothers went bankrupt, the entire system imploded, and the Treasury and the Fed had to come to the rescue. They injected a staggering amount of capital into the system, and the result was a recovery, but one, as we can see in this chart, was actually quite weak. So as we look at this chart, we see 2009, the dotted line on the bottom, is actually the slowest recovery on record. Now, it is one of the longer recoveries. We're now going into our 10th year without a recession. But again, we've seen consistent growth of GDP at the 1-2% range, and that is far, far below normal. And so what we're thinking, based on the economy, the acceleration, the tax package, and some other items we're going to cover, is we think that the economy starts to grow at a faster pace, and we start to resume a more normal cycle of higher GDP growth. By the way, higher GDP growth creates more volatility. Low, slow is a consistent growth pattern. As you get higher and higher in your growth rates, you get more volatility. That's natural. Higher the return, more volatility. So what's going to drive all of this economic growth? Well, the chart on the left shows the first place is going to be capital expenditures. So CapEx spending, we look to go up as we see optimism in the Small Business Confidence Index, the CEO Confidence Index, consumer confidence is up. As people get more excited about this economic recovery, that's usually followed by spending. And so the chart here on the left, we see that small business optimism is up significantly. We think CapEx spending follows right behind that. We also, by the way, have a new tax bill with lower corporate rates, a 100% deduction for CapEx spending, which, again, small business doesn't know how long that will last. So that starts to bring forward certain spending that may happen in the future. So this tax bill, we do believe, stimulates CapEx. Consumer confidence is high, and personal spending tends to follow consumer confidence. So across the board, optimism up, that's a good thing. We also think globally, we're going to continue to get drive from the global economic recovery. On this next chart, we see on the left that since 2016, the global recovery has actually accelerated. And on the right, we also believe housing is going to play a particularly important role in the recovery. This chart shows the affordability index. Essentially what that is take the price of a house and the mortgage rate, put them together. This is the affordability of housing. That index is elevated, not quite as high coming right out of the crisis, but still very high. And yet the dark blue line shows that inventories are down. So this is an important concept. If we don't have houses to buy, but they're affordable to buy, that means building has to kick up. That helps kick the economy up a bit higher. By the way, we also believe that this is partially due to the millennials are coming into the marketplace and they're starting to reach the age of home buying. So we know during the crisis, we heard millennials are not going to buy houses ever again. That's the kind of absolute thinking we try to avoid. And now we're starting to see some increased demand from the millennial market. Another potential driver of economic growth in 2018 is government spending. As we can see in the chart here, government spending has been particularly weak. It's as low as it's been since the 1940s. And so we have seen continual decline in government spending coming out of the crisis, where it actually ticked a bit higher, more than the average. Government spending is down. So the question is, what can drive government spending higher again? And the obvious answer is infrastructure. So we're starting to hear in the media talks of an infrastructure bill. That tends to be something that both parties like to do, spend money on infrastructure. What we also know is there's a need. The chart on the right shows that the estimated funding for different projects, roads and schools, electricity, water, parks, are in the blue, but the gap between what's needed to actually complete projects and the funding that is actually in place is actually quite wide. And in some cases, for example, roads is a massive funding gap. So there is room here for the government to step in. There's also room for public partnerships, public-private partnerships. That would be a great benefit to building out the infrastructure. Regardless, that will drive more spending into the system. Now, government spending, again, is not necessarily a driver in of itself. It's important to remember that the government doesn't create revenue. It taxes and then puts that money back into the system. So what's important about government spending is, do we get a multiplier effect where their dollar spent creates other spending from the private market? With an economy that's rising and confidence that's high, adding this extra element actually we think will drive economic growth. One of the concerns we have in the marketplace is inflation. So inflation in of itself is not a bad thing. A modest amount of inflation is actually good for an economy. The key is always not the number, but how fast we get to the number, how fast inflation is moving. So runaway inflation like we had in the 80s is obviously a problem. Deflation is a problem. Modest inflation is actually fine. We have had below average inflation for the last several years. We've had below average economic growth. What we are starting to see is pressure on inflation. As we can see in the chart on the left, it's actually starting to break away from its long-term average. As we look at the economy today with wage pressure increasing as unemployment comes down to remarkably low levels, an increase in CapEx spending, an increase in investment in business, there's no question that we're going to start to see wage pressure, commodity prices are rising, interest rates are rising, so input costs are going higher. We do think that leads to inflation. What we also can see in the chart on the right is it's actually already starting to show up in manufacturing costs. So the chart shows manufacturing pricing is starting to rise. And so it's inevitable, if it's rising at the manufacturer level, that eventually gets passed through to the rest of the economy. So we are mindful of inflation, we're watching inflation. And what's important about this inflation is if inflation starts to drive higher, that will drive interest rates higher. So this next chart shows the 10-year Treasury since 1979. And so what we see is that the 10-year Treasury yield has been on a 37-year decline, and we are just now looking like we're starting to break out from that long secular bull market in bonds, bear market in yields. Certainly, we would all like to have higher yields. Certainly, we all look at it as an advantage to earn 6-7% on a treasury in a portfolio. It makes our job a lot easier. But the road between 2 and 7 can be a very difficult one. So if you think interest rates are going higher, we have to be more defensive. And we do think they're going higher. The economy is starting to get a little heated. GDP growth is going up. And we talked about inflation coming back into the system. We really have to be mindful. And after a 37-year trend breakout, things tend to start moving very quickly. Another factor we think is going to have an impact on what happens with interest rates, and frankly the volatility of interest rates in the market, is really navigating through uncharted waters when it comes to the Federal Reserve's balance sheet and the unwinding of all of its capital that it's flushed into the market. The chart on the left shows that the Federal Reserve has increased their balance sheet from less than $1 trillion to over $4 trillion. So we know that the Federal Reserve did this to pull us out of the economic crisis, and they also, as we can see in the chart, dropped interest rates to zero. So fast forward to 2016, 2017, rates are starting to climb. The Fed is starting to pull itself out of crisis mode. That $4 trillion eventually has to be unwound. The problem with that unwind is we have never seen anything like this in the past. And so we are really going into uncharted waters where what's going to happen, we think this adds volatility as we unwind this incredible influx of money. The chart on the right shows one of the impacts that's already occurred. So as this capital came into the market, and we see in 2015, we started to see a proliferation of negative interest rate debt. I'm still fascinated by this. The concept of you give the government money and you pay them to hold it, and yet people couldn't get it fast enough. And so what that talks to is it talks to the issue of fear in the marketplace, wanting a safe asset, and even being willing to pay for it. Well, as we can see, that's already started to peak. It's coming down, less negative interest rate debt, but still, we've never seen negative interest rate debt, let alone this amount. That too all has to be unwound. So the unwinding of all this, we think, adds volatility. So if inflation kicks higher, and if the Federal Reserve continues to raise the rate, and if we see this unwind, the economy does well, and inflation is moving interest rates, the question is, what's the impact on our portfolio? This next chart shows the impact of different types of fixed income with movements in interest rates. So on the left, we can see a 1% movement in interest rates, which, just pause there for a second. We are at a 37-year low in interest rates. So if we just get a 1% move, what's the impact? Well, if we own a 30-year treasury, on the bar on the right, as we can see, a 1% move on a 30-year treasury, it can fall over 15%. A 10-year treasury over 5%. This is important. People look at treasuries and say they're risk-free, and the truth is they are. From a credit risk perspective, they don't have risk. However, from an interest rate perspective, long bonds are volatile, short bonds less volatile. So if you own a 30-year and interest rates go up, you're going to see incredible volatility. Yes, if you wait out the 30 years, you get your money back. But between now and then, you're going to see the price of that portfolio moving all over the place. Now, on the left side of the plus 100, we see that high yield has a modest gain during that interest rate rise. And obviously, floating rate notes, self-explanatory, as rates go higher, the rate of the note goes higher. That protects you in a rising interest rate environment. That's why we own floating rate notes. And so as we can see, that's a positive return in a rising interest rate market. So the more we increase it, if you look at a plus 25 BPS, which is basis points, you can see that volatility narrows significantly. So higher the rise in interest rates, more volatility. The reverse is also true. Look at minus 100. So if interest rates go down, then we see return go up. So there's that 30-year treasury earning over a 20% return. So now let's take a step back. Let's take a portfolio of 30-year treasuries and they go down 1% and then they go up 1%. You see this massive volatility swings. Whereas if we have a portfolio of 2-year treasuries, then we're going to see very little movement. So the key to this chart is simple. Do we think interest rates are going higher or lower? If you think they're going lower, then you take longer and longer bonds and take advantage of those big returns. But if you think they're going higher, and we do, then we have to be defensive. How do you do that? Own shorter bonds, own floating rate bonds, and yes, you can own high yields, but there's more to the high yield story than just the interest rate. On this next chart, we see what's called the credit spreads, and this is an important factor in our decision to allocate to high yield. In looking at this chart, you see in 2007, June of 2007, just before the financial crisis really kicks into gear, the spread between high yield and treasuries was very low, about 3%. What the spread is take a treasury yield and take a high yield bond yield, and what's the difference between the two? Well, if the difference is only 2 or 3%, what the market is saying is, I don't think there's any risk. I'm willing to only take 2% more to have a junk bond. Now, when the economy is stressed and we're fearful and we believe there's risk, we demand more return. And so, as you see in 2008, there was actually a record high spread, 18%, which means if you go out and buy a treasury for 2%, a high yield bond's paying 20%. That's because we were in the middle of the financial crisis. Everybody was afraid of everything, and so they demanded extremely high rates of return to buy a bond. Where are we today? We're all the way back down to 3. So what do we take away from this chart? Well, when do you buy high yield? Do you want to buy it when spreads are low or high? The answer is when they're higher, it's better value. You're getting a cheaper price for the bond. If you bought high yield bonds in 2007 and those yields went up 18% to 18% spreads, and we think about the prior chart where the higher the interest rates go, the faster the bond falls, that would be a big problem. You would lose money in a high yield bond. If you were to buy those bonds at 18% spreads and they come back down to 5, what's happening? The interest rates on the bond are declining, which means the bond prices are going up. Think to the last chart. And of course, that's beneficial. So as we look at high yield today, and we look at the marketplace, yes, the economy is good. Yes, that's good for high yield default rates, meaning better economy, less defaults, less risk, but that also means we're not getting paid for risk. So right now at a 3% spread to treasuries, we're reducing our high yields allocations because we just don't think we're getting paid enough money for the volatility that could be in front of us. So does this bull market have room to run? Well, it's been a long bull market. We're 9 years, we're going on 10 years. This has been a fantastic bull market. I think as you take a look at the bull market and you ask the question, is this a secular bull market? Well, as we come out of this very slow growth period and we think growth is accelerating, the answer is yes. We still think this market has room to run over time. That doesn't mean we won't see corrections sometime in the future. Volatility has to come back. As we look at this run, this is a long one. It's not the biggest, it's not the highest return, but there's no question it's a long run. We have not had a correction or a bear market in quite some time. In fact, it's been over 380 days since we've seen a 5% correction. That's a record. So we need to be careful. We need to make sure that when you get this long into a bull market, you have to stay disciplined in your asset allocation models, not get overly excited about stocks and not chase after these returns. This is a time to stay disciplined. So the question we get frequently is the market overvalued? Well, as we see on the chart, there's been 3 major bear markets since 1986. And the table on the right shows us different valuation measures in each one of those markets, and more importantly, the time period just before that bear market occurred. So what we know is before each one of these bear markets, times were good, people were excited, they wanted to buy more stocks, they were happy with their returns, and after the bear market, they said, boy, if I could have just known that we were overvalued, I would have sold. So is there a signal in the marketplace that valuations are high or not? Well, as we look, PEs, 1990, the PE in 1990, right before the 91 bear market, 13. 2000, which was an anomaly, 24, and 2007, 16. That's an average of 17. Where are we today? 18. We're a little higher than the average. We're higher in 2 out of the 3, just a little bit elevated. As we look at trailing PE, same story, a little higher than the average. Price to book, little higher than the average. The question though, price to cash flow is actually a little lower, and we're not quite as leveraged as we were in the prior markets, meaning the debt to EBITDA, how much debt we carry, is not quite as high. That makes sense since we just came out of a financial crisis that companies would be more conservative with their debt. What's the message here? Well, the message is relative to the 3 bear market averages in the year before the bear occurred, we're slightly elevated in 3 of these categories. However, if we were to strip 2000 out, where prices reached extraordinary levels in the dot-com bubble, it actually looks a little bit more expensive still. So yes, we are fully valued. Have we reached the point where we are accelerating straight up and we have what we call panic buy-in, where everybody's just buying indiscriminately? No, not quite, but we sure are close. It looks like we're fully valued. So what does that mean? That means that we're fully valued. We don't think we're overvalued yet. We think there's some room in earnings to run because of the tax bill and because the economy is going to continue to accelerate. However, this is not a time to get more aggressive in equities with these valuations. From an asset allocation standpoint, we just talked about bonds are really not attractive because if interest rates go back up, which we think they will, then bonds are not the best place. And equities are fully valued, maybe not overvalued yet, but definitely fully valued. So where do we put money? Well, the answer is equities are still more attractive than bonds of the 2. And this chart shows the earnings yield, which is the earnings over the price of the S&P 500 versus a treasury. And what we can see is that the earnings yield on the S&P is still higher than the yield we get on the 10-year, signaling that stocks are still more attractive than bonds. Additionally, the chart that we showed with full valuation is for U.S. stocks. We're also allocating capital to the international markets. And over the last several years, since January of 2013, when the market really started to accelerate, what we know is that the U.S. has really exploded to the upside, but the international markets, which is the red line, which is the MSCI EFA, which is developed international markets, has not moved up nearly as high as the S&P 500. So the question is that an opportunity? And we think it is. This next chart shows that valuations in the international market are actually quite low relative to the US. So what this chart shows is the higher the chart goes, the more attractive US stocks are. The lower the chart goes, the cheaper international are, therefore the more attractive they are relative to US. Additionally, as we can see on the chart next to it, margins in the US have exploded to the upside. Europe seems to be just behind us. They seem to be coming in just behind us. And so we think that valuations are more attractive in Europe and also that they have some more room to run in terms of their margin expansion. Additionally, when we look at the comparison of equities to bonds, it becomes an even more compelling story on developed international markets. This next chart shows on the right, you see the S&P 500, which is the S&P 500 minus the government yield on the 10-year treasury. So what it's saying is, for the first time actually in many years, the 10-year treasury is actually surpassing the S&P 500. That makes sense. Interest rates are going up and the stock market is going up, which drives the dividend yield down. But as we look at Britain and the Euro stocks and the CAC, which is France, or the German DAX index, Spain, all of these international markets, their dividend yields are still higher than their 10-year treasuries, signals that their equity markets are more attractive than their bond markets. One of our most important themes for 2018 is waking the sleeping bear of volatility. The chart on the left shows volatility, which is the VIX index, over the last several years since 1990. And as we can see, during the financial crisis, we hit this extraordinary high and set new records. and then it came down. Those two bumps afterwards of the European financial crisis. But other than those couple bumps, we've seen below average volatility. Now, what you'll notice on the chart is today we're actually at record lows. We're below even prior historic lows. The market has been almost asleep with volatility. This is an important point. When volatility gets this low, complacency starts to set in, something we definitely don't want to do in managing portfolios. And on the table on the right, we see different years where we saw very low volatility years, 1995, 2017, which as you can see is one of the lowest, 64, 58, and so forth, and the performance of the S&P 500, which this makes sense. When volatility is low, the market tends to be doing well. But what happens the next year? Well, extraordinary lows inevitably have to correct back to the mean. What's that mean? You get more volatility. So the following year, volatility climbs, and we got a very mixed bag of returns. So the market has run. We've been running for 9 years. Volatility has been extraordinarily low. What's the impact? We think volatility goes up, and we have to be looking at a lower rate of return than we've just seen in the past. That makes sense. Prices are higher. So what are some of the factors that can drive this volatility? Well, we talked about inflation. Valuations are higher. The problem with higher valuations, after stock markets make great runs like the one we've just enjoyed, prices are higher, valuations are higher, which means they're priced for perfection. So as we get problems in the market, even small ones, when you're priced for perfection, inevitably that leads to more volatility in prices in the marketplace. Another factor that drives volatility is leverage. If you borrow against your assets and pour it into the system, that's going to create volatility. And so as we look at this chart, going all the way back to 1951, this is total debt versus GDP. That means household debt, corporation debt, government debt, all versus GDP. And so as we could see going back into the 50s, it stayed pretty consistent at about 150% of GDP. Look at the last several years, the last couple decades, and the explosion of leverage. Today, up about 300 to 350% of GDP. Again, this is a long-term issue we have to deal with. We're not saying this is the cause of a great bear market, but when you have leverage in the system, when volatility comes, it tends to add to the amount of volatility. So how do we guard against volatility? Well, one way is to put in a hedge strategy. Hedge funds and hedging strategies, obviously, when markets are going up, hedging is not popular. Why do I want to hedge risk when everything's so good and everything's going straight up? That's what investors say. And the answer is because nothing goes up forever. And so this next chart shows the performance of hedge funds during down market months in the marketplace. So on the chart on the left, we see from 2010, all these down months, and look at the performance of hedging strategies during down markets. There was only a couple that were actually down. Largely they're up, and they're up significantly, the average of which is almost 2% above the market. And on the right, we see hedge fund strategies against negative bond markets. So again, we talked about the risk in the bond market. When we use hedge funds, we're hedging the entire portfolio. That's the point of having a hedge strategy. It's not correlated to either stocks or bonds, and it gives us a diversification, and one which tends to work well when markets are negative. So a hedge fund strategy can actually help us with risk-adjusted return in our portfolios. So this is our 2018 Themes and Outlook quarterly commentary. I hope this was informative. As you can see on the screen, we also have our website if you want to go and take a look at the written version of this and have a copy of the slides. Thank you very much for your time, and here's the disclaimers. Happy New Year.